Hey everyone, welcome back to Corporate Decoder, the place where we dissect the secrets buried in Wall Street's filings with a smirk and a steely gaze. Today we are diving deep into Kaiser Aluminum Corporation's latest report, and trust me, there are some interesting moves being made that you will want to know about. Kaiser Aluminum Corporation is a company that produces and sells extruded building products, aerospace and defense aluminum products, and automotive and specialty aluminum products. They have been around for a while and are a pretty significant player in the aluminum industry. So what is the big news? Well, Kaiser Aluminum has inked a major deal with Wells Fargo Bank that essentially reshapes their borrowing and repayment terms. Think of it like renegotiating a massive loan with your bank, but on a corporate scale. This isn't just a small tweak, it is an amendment that impacts how much they can borrow when they have to pay it back, and even how they can use their assets. Let's break down what this means for Kaiser Aluminum and essentially for us as investors or observers. The maturity date on their credit line has been extended. This is a big deal because it gives the company more breathing room. Instead of facing a repayment deadline in April 2027, they have pushed it out significantly. Depending on certain conditions related to their other debt, like their senior notes due in 2028, the new repayment deadline could be as late as October 2030. This extension is crucial for companies because it helps them manage their cash flow and avoid having to scramble to pay back a large sum when it is not convenient or financially feasible. It shows a degree of confidence from the lenders Wells Fargo and others involved that Kaiser Aluminum will be able to meet its obligations in the longer term. Now let's talk about the fees. They have adjusted what they pay on the portion of their credit line they are not actively using. This is called an unused line fee. Previously, it was a flat 0.25% per year. Now it can fluctuate between 0.20% and 0.25% depending on how much of the borrowing line they are actually using. If they use more of it, the fee might be higher or lower depending on the exact setup. This signifies a move towards a more dynamic fee structure that might reward the company for better utilization of its credit facilities. It is a small detail, but it shows they are optimizing their financial arrangements. Here is where it gets really interesting. Kaiser Aluminum now has the option to increase their borrowing capacity. They can ask for up to an additional $200 million. On top of that, they can add what is called a first in last out or film tranche. This is a more complex financial instrument, but essentially it means they can borrow even more money under specific conditions. This increased borrowing potential suggests that Kaiser Aluminum might have plans for expansion, acquisitions, or significant capital expenditures. Having access to more funds provides flexibility to pursue growth opportunities or to navigate economic uncertainties. They've also gained more flexibility in incurring new debt. They can now take on debt that might have a lower priority than their current loans with Wells Fargo. They can also secure new debt with assets that were not previously pledged as collateral for their main credit line. This is a significant loosening of restrictions. It means Kaiser Aluminum can be more creative in how it finances its operations or any new projects it undertakes. The old agreement was likely tighter on who they could borrow from and under what terms. This change provides more options in their financial toolbox. Another key change is the increase in asset sale capacity. This means the company can sell off more assets without triggering default clauses or needing immediate lender approval. For a company like Kaiser Aluminum, this could mean divesting non-core divisions or selling off underutilized property to generate cash or refocus its operations. Increased asset sale capacity gives management more agility to streamline the business and improve efficiency. Let's talk about the core of this credit line itself. The amended agreement sets a maximum borrowing amount, which is the lesser of $575 million. But how they can actually borrow that money is tied to something called a borrowing base. This base is calculated using a percentage of their eligible accounts receivable, meaning money owed to them by customers. They get a higher percentage for receivables from highly rated customers, that is the investment. Grade part, they also get a percentage for their inventory. They can also borrow against 100% of their eligible cash. This whole structure is designed so that the amount they can borrow is directly linked to the value of their current assets. It is a way for lenders to ensure that the loan is secured by tangible assets. They can also use up to $50 million of this line for letters of credit, which are essentially guarantees for other transactions. At the end of the day, when the loan is due, all the money borrowed plus interest and any other fees will need to be paid back. Now about the interest rates, they will pay either a base rate or something called the Secured Overnight Financing Rate or SOFR. On top of that, they will pay an additional percentage that varies. For SOFR loans, this additional percentage can be between 1.25% and 1.50%, and for base rate loans, it is between 0.25% and 0.50%. This variable rate is tied to how much of their credit line is still available. The less available credit there is, the higher the percentage they might pay. This is standard practice to incentivize companies to manage their borrowing levels effectively. Of course, with any loan come the risks. Amounts owed under this credit line can be called in immediately if Kaiser Aluminum fails to make payments or if they break any of the rules or promises outlined in the agreement. These are called events of default, and they include things like missing an interest payment or not sticking to certain financial targets. The agreement also puts restrictions on what the company and its subsidiaries can do. They can't just grant liens on their assets easily. They have limitations on mergers, selling assets, taking on more debt, entering into sale-leaseback deals, making investments, and even paying dividends or buying back their own shares. These restrictions are common in major credit agreements designed to protect the lender's interests. They ensure that the company doesn't take on excessive risk or deplete its assets in ways that could jeopardize its ability to repay the loan. There is also a condition related to their fixed charge coverage ratio. If their available credit falls below certain levels, which are specified in the agreement, Kaiser Aluminum must maintain a fixed charge coverage ratio of at least 1.0 to 1.0. This means their earnings must be at least equal to their fixed financial obligations like interest payments and lease payments. It's another layer of financial security for the lenders. To back all of this up, the credit agreement is secured by a first priority lien on pretty much all of the company's accounts receivable and inventory. This means if Kaiser Aluminum can't pay its debts Wells Fargo, and the other lenders have the primary right to seize these assets, it is the ultimate security for the loan. The full details of this amendment are in Exhibit 10.1. This is basically the legal document that lays all of this out in intricate detail. And finally, there is the cover page interactive data file, the stuff that makes these filings searchable for computers. So what does this all mean for Kaiser Aluminum? On the surface, this renegotiated credit agreement is a positive development. It extends their repayment timeline, gives them greater flexibility to access funds, and allows for more maneuverability in their financial strategies. The ability to increase their borrowing capacity by up to $200 million is a significant signal that they might be planning some ambitious moves. They are essentially fortifying their financial foundation to pursue opportunities. However, we need to remember the restrictions. While they have more flexibility, there are still safeguards in place to protect the lenders. The increased borrowing potential also means increased debt and interest payments, which could strain their finances if not managed wisely. The fluctuating interest rates also add a layer of uncertainty to their future financing costs. In terms of strategy, this move allows Kaiser Aluminum to potentially invest more in research and development, upgrade its facilities, or even make strategic acquisitions without immediately worrying about a looming debt deadline. It shows a forward-looking approach. However, the success of these future plans will depend heavily on the company's ability to execute its business strategy effectively and to generate consistent revenue and profits in the competitive aluminum market. We will be watching closely to see how they utilize this expanded financial firepower. Alright, that is our deep dive into Kaiser Aluminum Corporation's latest filing. What is your take on these financial maneuvers? Do you think this gives them the runway they need, or are there hidden risks we should be aware of? Drop your thoughts in the comments below. If you found this analysis valuable, please hit that like button and make sure you subscribe for more corporate breakdowns. And don't forget to check out our Discord community linked in the description below. Thanks for tuning in, and we will see you on the next episode of Corporate Decoder.